Ehsan, welcome into the conversation. Thanks for joining us. 1.2 million. Why do you say this is going to be enough to stem the declines that we've seen in oil?
Well, I mean, I think at the current juncture, the market has priced in about 1 million barrels of oil of production cuts, especially after the Saudi oil minister, there was reports that, he mentioned last week that that's what he wants the group to actually come down to. But we think that they could actually go a bit further. And given where the massive sell-off that we've seen in the last few weeks, that 1.2 million barrels per day of additional production cuts starting from Q2 all the way up until year-end, so that's 9 months additional cuts, I think that's where we see as our baseline scenario.
So this is going to be a go big or go home Corona cut. How do you think they're going to be able to get it done, though? And is there consensus among the group for that size of a reduction?
Yeah, absolutely. So they'll need to actually deliver a coherent and credible strategy to the market that actually suggests that it's been a harmonious, one-voice, united, approach in terms of cutting these 1.2 million barrels. And for us, the key sticking point going into this is the different oil market strategies between the two key producers, Saudi Arabia and Russia. Now, for Saudi Arabia, of course, their optimization strategy is for higher oil prices, which generates higher oil revenues. And our model suggests a budgeted oil price of roughly around $61 to $62 per barrel this year. So with current oil prices of where they are, naturally that's stoking fiscal constraints. Now, in terms of Russia, they've been able to broaden the tax base, they've been able to ramp up output, and keeping a lid on ruble appreciation. They're much more comfortable with oil prices roughly around the $50 mark. But we think, in the spirit of keeping the OPEC agreement alive, they will coordinate a coordinated action when they meet this week in Vienna.
Ehsan, it's a tough one, isn't it? Because at the end of the day, a lot of conversations surrounding what we saw several years ago with Ali Al-Naimi back in Doha. There was that famous move by the Saudis really to push the U.S. producers out of the market. Where does this leave U.S. producers today?
Absolutely. So, I think now, given that the marginal cost U.S. oil producers that are feeling the heat at $50 per oil barrel, naturally they will sort of ebb out the market. But I think going forward, if oil prices stay at where they are, then we could see another ramp up. But I think, of course, we need to see where demand and supply is. And our demand forecasts are currently showing for 0.6 million barrels per day of growth this year, and we've revised those down from 0.9 million barrels simply because of the impact of the coronavirus and the ramification it has on entire constraints around the world. So I think they'll need to balance supply and demand when they come to assessing in terms of ramping up their output.
We talk about that kind of debt that the U.S. producers carry. Mm-hmm. What happens to this region? How much trouble are we really in?
Well, if we take a step back and we look at the fiscal break-even oil prices, which is a natural starting point, a helicopter view, naturally, I think the more vulnerable countries that have higher fiscal break-even oil prices naturally will have to determine whether they actually go for fiscal stimulus and actually sort of spend their way out of this crisis and actually try to spur growth that way, or the opposite, try to narrow the deficits by actually curbing fiscal spending, which could it will be a credit positive thing, but naturally I think of course that will have an impact on credit on economic growth. So it will be a balancing act between how much stimulus do these governments want to actually do in order to spur spending, given there's such a massive impact this had on oil prices.